What's up, YouTube? This is probably one of the most important things that you want to understand if you want to run a business or if you want to invest and be successful with money. Leverage. This is lowest to highest leverage. By the way, my name is Felipe. I've built a multi-six-figure net worth by the age of 25. And today I want to talk about a little bit more on capital leverage, but I wanted to start just showing you guys from the lowest to the highest form of leverage. Labor and capital being permission-based, ranking the lowest, and code and media ranking the highest because they're permissionless. This is a form of media. I'm making this video. I'm educating you guys on all these different ways to make money and raise money in the capital markets within different industries. A lot of leverage. Code, for example, software. I work at a software company. They create software once, go and deliver it to multiple different people as a service. A lot of leverage there. Capital. You want to buy a house, you go and pull a mortgage. You want to invest in the stock market with more money, you go and pull a margin loan. We're going to cover that today. Labor, go and hire people to work for your business and pay them with capital that you just raised. And then you make ads. That's a form of leverage. And then you create a software for your business. And if you have a software business, you have all four forms of leverage. I am leverage for the business I work at. I am labor. Just an example here, like if you run a software company or if you run a YouTube media company, whatever it is, but it involves multiple different ways of leverage. And that's how I like to think about different businesses and different ventures that I go into. So there are a lot of ways that you can leverage capital. These are different ways where you can leverage capital within different industries. So investing, real estate, and business. So when it comes to investing, leverage ETFs, leaps, margin, SBLOCs, futures, and a 401k loan are all ways where you can raise money to either invest more money or get into another venture. Real estate, a mortgage, a HELOC, and a hard money loan, and a DSCR loan are also things that you can leveraging other people's money to make more money yourself. With business, you can have an SBA loan. You can have a 0% business credit card, a business line of credit. There are multiple ways where you can raise money if you run a business. So I wanted to cover that today very briefly because I could spend an hour speaking of these different terms and how they apply, use cases, blah, blah, blah. But today, the goal is just to introduce these terms to you guys. If there's a lot of demand for this, I'll make a more in-depth video on leaps or margin or SBLOCs, futures, how to get a mortgage, how to get a HELOC, an SBA loan, all these different things. But today, the goal is just to introduce this to you guys. So let's get into it. So leveraged ETFs. You guys have seen me talk about my Microsoft position that I just opened where I'm long with a doubled leveraged ETF. And I've talked a little bit more about vol decay, and that's one of the main downsides of it. But let's talk about what are leveraged ETFs. This is basically a fund, and they're using swaps and derivatives to reset its leverage every day. So every day that the market's open at time of closing, they go and reset the leverage. They go and rebalance that to exactly 2x. Every day that goes by, they go and reset that clock. So on a sideways market, you can actually get pretty burnt with leverage ETFs. So that's essentially vol decay and beta slippage, another term that you can refer to. But it silently kind of erodes your position in a sideways market, because if you're buying high and selling low every day and you're trading sideways within that channel, your money is going to keep going down. So these are leverage ETFs. Let's talk about leaps. So these are deep in the money, long dated options contracts that gives you more exposure to an underlying stock with less capital. So you're buying the right to control 100 shares with, it's an options contract, and your delta determines how much you participate in that move. So if you have a higher delta, you're going to have more exposure to the underlying and have more intrinsic value in your contract. If you have lower delta, you're going to have more extrinsic value dictating the price of your contract and less exposure to the underlying. The one risk is that theta decays really hard, especially 90 days within contract expiry. And your contract can also get crushed by implied volatility. But if you have a high delta contract, IV won't be much of an impact for you. Like I said, I could spend like 30 minutes explaining this, but I'm just introducing these terms to you guys. So let's talk about margin. This is another way where you can raise money to invest or do whatever you want with the money. It's essentially you have your funds in your account, and then they're giving you more money to play with. And you, of course, have to pay a fee. So a lot of times they actually let you borrow 50% of your account. The thing with margin, though, it sounds great on paper, but you can actually get margin called if your investments go down to a certain percentage. So there's something called a margin maintenance ratio. And if you're not meeting that maintenance ratio, they can go and liquidate your investments and meet the margin requirement, Robinhood will go and then sell your investments to pay the margin loan because they don't want you to be insolvent. So that's the bad thing with margin. You are actually kind of forced to sell at a bad time. This one's one of my favorites, SBLOC, securities backed line of credit. This is essentially where you're borrowing against your portfolio, but in a different way than margin. You actually are able to use those funds in doing different things. So maybe you have a lot of Google stock, you want to borrow against those stocks, and a loan is not a taxable liability. So let's say you have $200,000, you get an SBLOC for 40 grand because you have to put a down payment. That money, that 40 grand is non-taxable. So that's the beauty with SBLOCs, and any loan that you take is non-taxable, including margin. This is, of course, a little bit more expensive and it requires a little bit more capital. This is when you see like Mark Zuckerberg and Elon Musk, Jeff Bezos, whoever it is that own a big company and living their lives, tax-free. They're taking SBLOC loans because loans are not taxable and they're borrowing against their portfolio. They have such a big portfolio, they own these companies. So this is an intro to SBLOCs. Future trading. I'm not the biggest fan of futures just because of the leverage that these instruments have. They are simpler to understand than options. However, it's essentially a contract where a trader puts margin and buys that contract and then sells it to someone else in the futures market. And you can have exposure to these contracts at a very low cost. So you usually have so much leverage attached to futures. Price can move against you. Not a big fan. Honestly, I do not recommend trading futures. It seems to be like a very big trend on opening a futures account and beating one of those funded accounts, whatever it is. I'm not a big fan, maybe because I've never learned how to trade futures properly. I just think there's too many ways that you can blow up your account. But this is another way where you can have leverage in the stock market. 401k loans, I'm also not the biggest fan. So a little bit different than an SBLOC or a margin loan. This is structured where if you have like, let's say 100 grand in your 401k and you want to borrow let's say 10K, they go and sell 10K worth of that 100K that you have to give that to you. And then you pay interest on that money. So it's kind of like you're withdrawing money and then you pay interest to them. So the way it's structured, I think it's actually kind of a trap. It's very different than an SBLOC or margin. You don't have to sell any of your investments if you want to get into one of those. The big thing here, and I think the biggest downside with the 401k loan, is that you do get the money to you, but you're kind of withdrawing from your future self. So you don't have that money working for you. So that's the biggest downside with the 401k loan. And this is another way where you can raise money in the capital market. So diving into real estate, let's talk about a mortgage. I think the 30-year fixed debt is probably the best financial instrument that there's probably ever been. If you buy a house, not a financial advice or anything, but I recommend you get a mortgage. One of the better investments that you could ever have is a house. It appreciates 3% every year and honestly just kind of keeps up with inflation. But for a lot of people, like, you need a place to live. There's also property taxes and maintenance and repairs that you have to do with a home. But this is how you can leverage yourself up with real estate. And I've been talking about the 30-year fix, but you have adjustable rate mortgages. You have a 15-year mortgage. When you get into commercial, there's, a 5-1 balloon, a 7-1 balloon. So there's multiple different mortgages that you could get in different assets when it comes to real estate. A HELOC is super interesting. They actually loan up to 85% of the equity position that you have in your house. And they go and take second position loan in your house. So first position would be the bank, or if you own the house outright, they'll take first position. This is a way where you can have equity from your home as part of a loan. And it's not cheap. It's expensive. It's probably SOFR plus 3 points. You're looking at like 8% loan. If you have a house that you don't want to sell, or if you want to just pull more leverage out of the house, you can get a HELOC. It's called a home equity line of credit, and you don't have to sell the house. Selling houses suck. So don't sell a house. Get a HELOC if you want some money out of your property. Of course, do your due diligence, not financial advice. So this is a hard money loan, and I'll pair the DSCR with this as well. This has been something that I've been getting into a lot more recently as I want to get into a flip or even a rental property. So this is mostly used whenever you buy an off-market property from a wholesaler. You need a hard money loan and it access cash. So the terms are usually very short term. So it's usually a 6 to 12 month loan at 1% interest a month. So super high interest. If you're borrowing 95% loan to cost or maybe 75% loan to value after the property is repaired. It's a lot of money. So it's short-term bridge debt, they call it. So it's just kind of like a means to an end. Like you buy a very ugly house, you go in there, you repair it, which they also lend out money for you to do your rehab. Depends how you structure your loan. You go and then fix it. The property's not worth more. Then you go and get a DSCR loan. The DSCR loan is beautiful because it only looks at the property and the money that the property makes. It doesn't matter if you make $2, $20, $20 million a year. They're only looking at the property and if the property is cash flowing or not. That's this DSCR loan and hard money loan. SBA loans. So this is a way to raise money if you have a small business. Of course, like they're not just going to lend money to you when you open an LLC and you say that you start an e-commerce brand and you want $700,000. That's not how this works. There is a small business administration where the government typically guarantees like 85% of that loan. So it encourages them to give money to people like me and you that are starting a business. But you do have to have some proof of concept, you have to have a good credit score. And actually, whenever I was running my car sharing business, I got offered to buy a business from this other guy that was running a much bigger fleet. And I was going to raise money with an SBA loan. It was going to be around 600K and they were requiring 10% down. So only 60 grand down to access of 600K. And the rates were actually not that bad. They were like around 6%. So this is a way to raise money if you want to start a small business or if you already have one and you want to expand. 0% business cards. This is a phenomenal way to spend money in your business knowing that you can pay it off. So different than personal credit cards, you have a business credit, but it does not get affected if you don't pay it. So, you've always heard of you pay your credit cards in full, do not accrue interest. A lot of these business cards, though, they encourage you carry a balance for the first 12 months. They give you 0% APR. So it's essentially like, hey, Felipe, I'm giving you this Chase Business Unlimited. I'll give you 40 grand for you to spend. I go and rehab a house, whatever it is, buy inventory for my business, buy whatever I have to buy. And then I have 12 months to pay that money back at 0% interest. So extremely powerful way. I would be careful though, because let's say I buy a house and then I end up losing 60 grand. So now I owe the credit card people 40 grand. And then I also owe my other lender 20 grand. So where am I going to raise that money from? Get another credit card? So that's the big thing with 0% business cards. You have to know what you're doing. Of course, everything's risky, but yeah, if you have a good idea of what you're doing and this fits your business, I think it's a phenomenal way to raise money. So a business line of credit. So this acts more in the lane of the credit card, where a bank is then giving you money for you to operate your business. It's a little bit more lenient than a SBA loan, for example. So just a different way. It's a revolving line of credit where Wells Fargo, Bank of America, Chase gives to you so you can run your business. So it's actually a great way to raise money as well. And unlike a credit card, you can draw and pay back, draw and pay back. So this is the business line of credit, another way that you can raise money if you're running a business. So hopefully you guys enjoyed the video. If you're still here, don't forget to subscribe. I know this is a different style video. I was going through all of these really fast, and I just trying to introduce you guys to all these different terms and what they are. I'll do a specific video for each one of these as the weeks go by, if there's, demand for this. So let me know in the comments what you guys think. So hopefully you guys learned a thing or two. If you did, don't forget to leave a like and subscribe. I'm growing my portfolio and I'll be teaching you guys how to do all of this. Don't forget to subscribe and leave a like. I'll talk to y'all soon.